Welcome to today's presentation on reading the smart money, insider trading filings. In this session, we will explore how to legally track executive buying and selling activity and understand its implications for your investment portfolio. Please note that this information is for educational purposes only and does not constitute financial advice. We encourage all participants to conduct independent research and verify facts before making investment decisions. To begin, we must define what we mean by insider trading data. Insiders are individuals such as executives, directors, and major shareholders who possess the deepest knowledge of a company's internal health. Tracking their trades is critical because their transactions often signal internal conviction or potential concern regarding future prospects. Because these reports are public, they provide a legal and transparent signal that every investor can utilize. It is essential to distinguish between legal and illegal insider trading. Legal insider trading involves corporate insiders buying or selling stock and reporting those transactions to the SEC. This is the transparent data we analyze. Conversely, illegal insider trading involves trading on material non-public information, such as unannounced mergers, which is a federal crime. Our focus today is strictly on the analysis of public, legal disclosures. The fundamental dividing line between legitimate research and criminal activity is public disclosure. If a trade is reported to the SEC and made available to the general public, it is a valid data point for analysis. If a transaction is predicated on secrets that have never been shared with the public market, it falls into the category of a crime. We operate entirely within the realm of disclosed public records. The primary document for our analysis is Form 4. This is a mandatory filing submitted to the SEC within 2 business days of any insider transaction. Available for free on the SEC EDGAR database, Form 4 provides comprehensive details including the insider's name and role, the number of shares traded, the transaction price, and whether the activity was a purchase, a sale, or an exercise of options. Efficiency in reporting is mandated by the 2-day disclosure rule. Once an insider executes a trade, they must submit Form 4 within 2 business days, at which point the data is posted on SEC EDGAR for public viewing. This tight reporting window ensures that the market receives near real-time signals, providing a significant informational edge to investors who monitor these filings closely. In terms of interpreting these signals, buying is generally a much stronger indicator than selling. Insiders typically buy for one primary reason. They expect the stock price to rise, making it a high-conviction signal. Selling, however, is often ambiguous. Insiders may sell for various reasons unrelated to company performance, such as tax obligations, diversification, or personal expenditures. Therefore, selling should not be overinterpreted. The size of a trade is also a critical factor in determining its significance. While a $5,000 purchase may be routine, a $1 million investment by a CEO sends an unmistakable message of confidence. Context transforms a simple data point into a meaningful signal. We must compare the trade size to the insider's net worth and existing holdings to determine if they truly have skin in the game. One of the most powerful indicators we track is cluster buying. While a single insider purchase is noteworthy, the signal strength multiplies significantly when multiple insiders buy shares simultaneously. When 4 or 5 executives all commit personal capital at once, it often suggests a collective internal optimism that can serve as a potent catalyst for the stock. The identity of the person trading also influences the signal's weight. Transactions by the CEO and CFO are the most informative because of their deep operational knowledge. Board directors provide strategic-level insights, which are particularly significant when they align with executive buying. In contrast, 10% shareholders may be passive investors, and their activity should be treated with more caution. This table summarizes how to evaluate Form 4 data. We assign the highest signal strength to large trade sizes and cluster buying, both of which are high-conviction markers. Buying activity and purchases made after a price drop also carry significant weight. While the role of the insider is important, it is the combination of these factors that truly validates the strength of the signal. Moving to specific strategies, we find that insider signals offer a distinct edge in the small-cap market. Because small companies often lack extensive analyst coverage and public information is sparse, insider signals fill a critical information gap. Research consistently demonstrates that the predictive power of these filings is greatest in small and micro-cap stocks where information asymmetry is highest. Another effective strategy is using insider data to spot undervaluation. When a stock experiences a sharp price drop, but insiders respond by purchasing shares with their own capital, it provides a powerful contrarian signal. This behavior suggests that those with the most intimate knowledge of the company see a value opportunity that the broader market is currently overlooking. Regarding sentiment tracking via selling, it is important to remember that mass selling does not necessarily forecast a crash. While coordinated selling might suggest a stock has reached fair value, it rarely predicts a collapse. Investors should monitor sell-to-buy ratios and distinguish between automated, pre-planned sales and discretionary transactions to better understand internal sentiment. It is vital to emphasize that insider data should not be used as a standalone strategy. Rather, it should be integrated with fundamental and technical analysis. When an insider signal aligns with strong financial metrics and favorable price action, it becomes a powerful confirmation tool that enhances the probability of a successful investment thesis. There are several reliable platforms for accessing this data. SEC Edgar remains the official, real-time source. For more user-friendly analysis, OpenInsider offers excellent filtering capabilities for trade size and clusters, while platforms like Finviz and Nasdaq Insider provide aggregated feeds and visual dashboards that are useful for assessing broader sector-level sentiment. To avoid common pitfalls, investors must be careful not to overweight selling activity, which is often driven by personal financial planning. Additionally, always consider the context. A small buy from a wealthy executive is less meaningful than a similar buy from a director with fewer resources. Finally, remember that insider data is not a guarantee, as macro forces can impact even the most well-positioned companies. We must also acknowledge the inherent limits of this data. Even with deep internal knowledge, insiders can be wrong about broader macroeconomic trends. Recessions or sector-wide crashes can negatively impact healthy companies regardless of insider confidence. Furthermore, insiders often buy very early, meaning their thesis may take considerable time to manifest in the stock price. In summary, remember these key takeaways. Prioritize buying signals as they reflect true conviction. Look for cluster activity to amplify signal strength. Focus on small caps where these signals provide the greatest informational edge, and always layer insider data with other forms of analysis to ensure a comprehensive investment view. As we conclude, I encourage you to start following the smart money by utilizing these underused public resources. Begin by searching Form 4 filings on SEC Edgar for companies on your watch list, screen for clusters of simultaneous buying, and integrate these signals into your existing analytical framework. By doing so, you can leverage the same data used by professionals to inform your portfolio decisions.